The restaurant business is extremely tough right now, and one of the companies feeling that in a big way is Portillo's. The company has already dropped like a rock over the past couple of years. Now, shares are down after the company reported earnings, but actually shares are actually up 15% year to date because there's at least hope that we've hit some sort of bottom. You can see here that the market cap for Portillo's is just $426 million right now. And this is still a company that's generating positive adjusted EBITDA, positive operating cash flow. So I want to dig into the numbers and the good and the bad from Portillo's, what management is doing. They've got a new CEO who's coming in who should change the direction. We know a little bit about what's going to happen, but let's dig through everything. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with some of the high-level numbers, because this is the first thing that I always look at with any restaurant stock is what's going on with the same restaurant sales or same store sales. If you're looking at a retailer, negative 3.3% in the fourth quarter of 2025. That's not good, no matter how you slice it. What management said is the ticket was flat, despite the fact that they were raising prices. That means that people are going for more discounted or less expensive items, and then also traffic was down. Now, this is something that's actually been consistent across the restaurant industry. So I think there's a few things going on. One, some people are going out to eat less. That could be because of economic conditions. It could frankly be because more people are using things like GLP-1s and just craving things like Portillo's a little bit less. But the other thing is that high prices are putting pressure on consumers. Now, one of the big things that Portillo's has kind of waffled back and forth on over the past year is how quickly is this going to be an expansion company? My theory when I bought shares of the stock a couple of years ago was that this was going to be a growth company, really good unit economics in their core business. And then if you can expand that into other areas, Texas, Florida, Georgia, that is going to be something that's going to be scalable long-term. And it will actually help as you build out more scale in each of those cities. That actually hasn't worked out well for Portillo's. And a big reason that they pulled back on their expansion plans, I think they were originally planning 16 new units in 2026. They pulled that back to just 8. So now we're looking at a little less than 10% growth for the year, and they're fighting commodity inflation. So what's ended up happening is the core markets, particularly in the Chicagoland area, continue to do really well, continue to have solid unit economics. But those other markets, particularly in Texas, there was this boom when they opened up stores, and then it just didn't last. The revenue that they were generating per store didn't live up to those expectations that they had. That's led to weak unit economics. So they pulled that back and said, hey, we just want to focus on the top 8 stores that we have the option to build in 2026. We're going to space out our expansion in some of these cities. So for example, they recently opened in the Atlanta area. That restaurant did really well at opening, but they're not planning on opening their next restaurant there until next year. But as far as outlook goes, they're expecting mid-single digit commodity inflation. So you're fighting the cost side of the business. Labor inflation also going up 3 to 5%. So they're not going to be able to increase their prices 4 or 5% to offset this. That means their margins are going to be relatively weak at 20.5 to 21%. And so despite opening some new units, having some other units that were open late in 2025, contributing for the full year, adjusted EBITDA expected to be flat for the year. The good news is some of this capital expenditure spending that they were doing to expand the business is going to come down a little bit, $55 to $60 million. And what they're doing is they've got this new restaurant of the future 1.0 concept. It's about 20% smaller than older restaurants. And this is what they're opening in most of their new markets. The other one is going to be this inline version. This is in the Chicagoland area. So we'll have to see how those things perform in the future. But you can see these trends just not where you want to be going for Portillo's. They did have nice same-store restaurant sales growth in 2023, but now it's been negative for the past 2 years. Restaurant level adjusted EBITDA has gone from 24% down to 21.6%. Like I showed earlier, that's going to expect to be even lower in 2026. As a result, you have less net income, less adjusted EBITDA for the business. So even at about $100 million in adjusted EBITDA, the price is not terrible for Portillo's. $426 million market cap. Yes, you have some debt on the balance sheet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. But the reason that I'm not selling my shares is you still have optionality in this business. I want to give the new management team time to try to turn the business around. So improve the operations at existing restaurants and then figure out how you're going to grow this business in a more sustainable way. I think instead of growing 12 to 15% unit growth on a year-over-year basis and then expecting to continue the same-store sales growth, maybe the growth rate should be more like 5 to 10%, and then focus on having each one of those units be really, really profitable. That would be a way to have a little bit more sustainable business. And it does look like the restaurant build out throughout the US in particular has kind of gone a little bit too far. So whether you're looking at fast casual or even just fast food in general, it seems like a very oversaturated market. All of the companies in this segment are seeing the same kind of pressures, seeing less people coming in to eat. Maybe that means that they're pulling back as consumers. They're seeing pricing pressure, so commodity price pressure, labor price pressure. That's put a lot of pressure on a lot of different companies. Eventually, that's going to mean that there's going to be less supply in the market. Some restaurants are going to close. Portillo's does still have good unit economics, so they should be able to be one of the companies that survives some of that fallout, but doesn't mean that it's going to be an easy couple of years ahead. But like I said, I want to give management at least the opportunity to show that they have some sort of turnaround plan that's going to potentially work. But this one is on a short leash for me. It's the one that I only hold right now because the valuation has gotten so compelling, but I'm not buying more at this point because I don't want to see those unit economics continue to get worse. Something that should always be a red flag for investors. But hopefully that's helpful in understanding what's going on at Portillo's. Let me know what you think about Portillo stock today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.